Marty, first of all, thanks to you and everyone at Ivy Family Office Network, and thank to you for being here and all of you that are online. It's really my pleasure today to interview and chat with Jeff Assaf, the founder and co-CIO of ICG Advisors. I've known Jeff for, we figured out, 30 some odd years now, which dates both of us.
Something like that.
And I have the pleasure and proud feeling to call him my friend. I'm going to start with a quick anecdotal story. When I first met Jeff, he was at Oppenheimer and Company, and I walked into his office in Los Angeles to pitch whatever fund I was pitching at the time, and he said no. And then Jeff moved to Bear Stearns.
I didn't say no, but we didn't invest.
Okay. Then he
I'm
moved
not
to
that direct.
then he moved to Bear Stearns, and I came into his office again, and I pitched him on whatever I was working on in those days, and he didn't invest. And then Jeff started his own firm. I was at a different firm, third time's a charm, and he invested. We ultimately sold that business, and it created a liquidity event for me. And I thought to myself, who's the smartest guy that I know, that I like, that I would want to manage my money? And it was an easy choice, and it was Jeff. And I once introduced him at a different conference and said that he had been my client and now I was his client. And I like it much better on this side of the table because Jeff is one of the smartest investors I know. He brings an incredibly forward-looking perspective to wealth management. He's very creative, and he and his team have a unique ability to create custom solutions for your clients, whether high net worth individuals or institutions. He's also shown amazing leadership skills, which have allowed him to build an incredible team, many of whom have been with him for almost the duration of his career. How long has Jewel been with you?
37 years.
So he's built a terrific team of smart, good investors, good back office people, good ODD people, but most importantly, they're all really great people. Jeff sets the strategic direction for the firm and manages client relationships. He has to put up with me, and supervises all portfolio construction and modeling. He sits on many philanthropic boards, which I also think is a wonderful attribute. And I don't know one of his friends who would say that he isn't always there for them. Jeff, do you want to give us a little description of ICG? It's better coming from the horse's
Sure.
mouth, and then we'll get to it.
Yeah, we're we're an outsourced CIO. We're headquartered in Los Angeles. The answer to the question that was asked is probably half our clients are Southern California because we're there. Maybe at 60%. The rest are literally scattered all over the country, including here. And they're mostly families. There's like a dozen small institutions, and the rest are larger families, like 75 clients, 70 clients. And all we do is investing. We're not like a multifamily office that pays bills and figures out, buys airplanes. We just invest capital. And lots of our clients have those functions in their office, but they just don't have the investment part, and that's the part we handle.
Except when people like me call you up and say, how do I buy car insurance?
Well, we're also nice people, so we can help people, but that's not what we get paid for.
So let's jump right in. What led you to the investment business, and what today, all these years later, do you find most enjoyable about it?
What led me to it was my business school economics professor. The people that are my age remember the name Art Laffer, and the young people don't know who that is. But Art Laffer and my college fraternity brother, who was in the investment business and told me that I should go in it and said I would be good at it. So I didn't know what I wanted to do, and I thought, why not? And I don't know if I'm good at it, but it worked. So that's what led me to it.
But what do you find most enjoyable about it?
I love helping people. And money is a remarkably psychologically complex topic. In college, I was a psychology major. And in business school, I studied finance. And what I do for a living really combines both of those, and it's equal parts. Uh, I like helping people. I'm the oldest of 6 kids. We're all 1 year apart. So I've always had, I grew up having people wanting my help or depending on me, or me being expected to help because I was the oldest. And helping people with their life savings and keeping them out of trouble and keeping them calm when, I mean, look, you can see what's going on right now. It's pretty crazy. It's rewarding to do that. It's really genuinely satisfying to do that. And it's interesting because we're an CIO, not a single asset class manager. So we're not always just looking at biotechnology companies, which these last 2 talks were very interesting for me. And I would like to actually chat with both of you guys afterwards. But in any case, we don't just look at one thing. It's fun because we look at lots of things. So it keeps it interesting.
But you're a part-time shrink.
Anyone who does what I do is a part-time shrink. Yes.
What do you think differentiates ICG from your competitors? What's your edge, so to speak?
I don't know if it differentiates us, but I can tell you what I think our edge is, and then you all probably know other people who are similar. We are a very research focused operation. We've got 28 people in our firm. Our firm manages $8 billion. We have 70 clients. The majority of that is research, and the majority of those people that are involved in the research process have been at the firm for a very long time and worked together for a very long time, like 25 years together and more. And I think that cohesiveness of a group of people that know each other as well as we know each other allows us to parse through things faster and cut to the chase with more accuracy, and therefore not waste too much time on things that aren't going to make sense either for our clients or in general, because we just don't think they make sense, and allows us to get to what does make sense, which in the end is what ends up in client portfolios. And the reality of it is, this is a performance-driven business, although there's a debate about that because I see lots of firms that manage lots of money that I don't really think are that good. So it may be a marketing-driven business, but I think it's a performance-driven business. And I think our work in research and the years that we've done it together is probably what gives us the edge.
I would say also one of your edges is you guys have a reputation for identifying emerging talent, getting to managers
Yeah.
early and being good at it, because many of the managers you've invested with either day one or very early have gone on to be incredibly successful. Why do you like the emerging manager space, and why do you think, what advantages do you think it gives your clients?
Investing with startup firms is more work, which lots of people just don't want to do. Lots of people are also really too big to do that unless they set up a separate area that doesn't need to allocate bills. Big shops either have to set up a separate area to do that or not do it. And it's a lot of work. But the flip side of it is it's very rewarding. Like you just said, Suzanne, we've probably done this over my career 30 times where we've either been like founders, share class, or seed investors with some manager. All those economics go to the clients, not to us. And that could make a big difference. When I talk to you guys afterwards, I'm going to talk to you about some healthcare guys that we invested with long ago, and they're excellent. But the point is to just kind of like drill down as an example. It's a long, short equity manager that invests entirely in the biotechnology space. They're very good. Just take my word for it. They charge their investors 2 and 20, which is not everybody can get away with that. They do, and they deliver results that are fantastic at that level. Our clients pay 1 and 10. That's a big difference when you add that up on many millions of dollars and do it for a decade. That all came from doing early work and deciding there was something there. We've done it lots of times. I'm only using them as an example because I was so intrigued with both of you talking before me and what you were talking about. Because the reason I'm intrigued is because I'm in New York this week because I'm on the board of a national charity called Shatterproof. And Shatterproof is the largest charity in the nation dealing with the opioid crisis. And we had our board meeting yesterday for 6 hours. And lots of things happened, but listening to what you were talking about, anyhow, so
Yeah,
there's,
stay on topic,
yeah,
please.
there's, investing early is very rewarding if you're willing to do the work. That's the bottom line. And we like it because we've seen that it pays off.
So how can you and wealth managers in general balance your clients' demand for high returns, right? We all want to see at the end of the year we've made a bunch of money, but with the need for low volatility, resilient portfolios, particularly in uncertain markets. Right? I mean, we all think as clients, or many do, that we're still in or want to be in the get rich business, but what many of us need to be is in the stay rich business.
Well, if you're one of our clients, you're by default in the stay rich business. Our clients have a lot of wealth. We don't even have the ability to manage $1 million or $3 million or $5 million accounts. It's doable. There's firms who do it. It's just a different business from ours. So our business really is in the stay rich business, using your vernacular. But the answer to the question is, the easiest way is to convince clients that they don't need to get high returns, but that's not easy to do. It really comes down to defining what people really mean by high returns and what they really mean by risk. And the reality is there are so many, and this is where psychology comes in, there are so many people who say, I'm a long-term oriented investor. And they are, until the wheels come off and things get crazy. And then their time horizon rapidly shrinks and they start wanting to adjust and delay and get out. And of course, all of that sort of capitulation is the recipe for losing. So it's probably, it's before the portfolio gets constructed, and it's the psychology part of investing, so they can really understand what clients really want and what really drives them, so that when we construct a portfolio, it doesn't offer surprises outside of what they've told us they think they can live with.
So you have a client base that has a balance of very sophisticated investors, right? Money
Yeah, yeah.
managers who want diversification away from their core business.
Mhm.
And then you have a bunch of people like my mother, widows and orphans, or a woman who sold her company and has never made an investment because she was investing in her business and
Right.
was used to having a cash flow or money from a single thing. The sophisticated guys, you don't need, you're a very alternatives focused firm. The sophisticated guys, you don't need to teach about that. How do you teach the less sophisticated investors about the complicated investments you're making?
Well, wow, that's a loaded question. And I know this is being recorded, so I have to be careful what I say. The answer is, there's a good chunk of our clients that don't want to really understand that. They're not really trying to understand how the biotechnology healthcare firm is picking the stocks that they own or shorting the stocks they're shorting. But I'll focus on the few that do. On the few that do, it's a matter of spending time with them, and there's a prayer element to it, which is that they have the capacity to understand it. And some people do, they just need to be told, others don't. Sometimes we'll lean on the managers to help us, help clients understand what an investment process looks like. But the real truth of the answer is, we don't spend lots of time on that, because that's not a productive use of time, other than to give that investor some sense of, it also depends on if somebody's asking because they genuinely want an education or they need it for calmness. If they need it for calmness, that's not,
You take them out for a glass of wine.
yeah. Yeah, okay. We'll go with that.
So, so we all know there's a lot of talk about AI and machine learning and what that looks like. How do you see that changing portfolio management over the next 10 years? Or maybe you don't see it changing because you think the human element is much more important because I mean, I certainly believe, having been in this business a long time, and I think somebody said it yesterday, I think maybe it was our friend Chip Perkins, you got to look a guy in the eye, you got to get to know them, you've got to build a relationship with them, you've got to trust them, and AI and machine learning really can't help you do that. But
No, it's not, I don't believe it's going to help with that. What it does help with, and what it's really going to help with, is it's not so much with what we do, it's more with what those guys do. The the effect, especially in places like healthcare, the speed with which discoveries can be made and trials can be done and mistakes can be quickly ended because of the impact of what AI will bring to the table is going to turn the ability to make money, I think more so than any other sector in the healthcare space. It's like a slow pitch or like T-ball. And I think investors who understand that and can take advantage of it are going to be surprised at how much money they can earn. And a lot of that is going to be driven by the effects of what AI can offer. I mean, there's a zillion things AI does. Like, we live in Los Angeles, my wife and I do. Um, some of you know what Waymos are, or maybe all of you do. That's AI, and it's nothing. I mean, it is until you get in one and you realize how easy it is. But just the notion of what can happen and what is going to happen is going to really be remarkably transformative. I don't think it's going to replace clients sitting down. I don't see your mother, like, it
that's a
doesn't work.
special case.
People need people, especially when it comes to their life savings. But the leverage that people with the tools can get and the value add that will be created will be remarkable.
So for example, efficiency and operational due
Yeah.
diligence and all those kinds
Yes.
of things.
Yeah, like reading an offering doc and pulling out the words instantly instead of actually reading. We have a woman who she knows who runs ODD for our firm.
Who's excellent, by the way.
She is.
Torturous, but excellent.
And what's happened for her in the last 5 years, she's been with us for 10, and in the last 5 years, the ability to get through documents is crazy, night and day different. It's unbelievably efficient. So it'll help.
Okay. Yesterday, there was a family office investor here talking about being interested in investing in the idea of, and I wasn't sure how she was going to go about investing or if there's a fund that's doing it, the roll up of RIA trend that we're seeing
Mhm.
happen. And I wonder what you think about that as an investment strategy, number one, and would you invest in it? Or number two, would you just go on the path of acquiring firms yourself?
Well, I wouldn't invest in it because what's that expression about don't
You
Chip,
can't say it.
yeah, I can't say it, but Chip knows what I'm going to say. I wouldn't invest in it because I earn my living from that, right? So I want to be diversified, not concentrated in one thing. What do I think of it?
Well, but forget you. What about
Yeah.
investing in it for your clients? Because they don't make a
No,
living from
I
what you
would
do.
not, because I don't understand the multiples that these guys are paying for the earnings that firms like mine generate. I mean, we make a good living, it's great, but multiplying it by sometimes 20 and sometimes 25 times our industry's version of EBITDA, which is not EBITDA, but whatever, that's not, I don't think that's a good investment. Is it bad? No. But are there better places to put money? In my opinion, yes. Now, if somebody wants to buy us for 25 times, I don't want to scare you away. You can come and have a conversation with us, but we wouldn't be invested in the fund that was doing that.
Got it. So, and this is a loaded question, particularly after yesterday in New York City, but how are you as a firm thinking about the world political climate and how it affects your clients' portfolios and how you're thinking about positioning going forward?
Um, the answer to this is more related to what goes on in the country and the world is driven by Washington, D.C. since the Trump administration arrived than what happened in this city yesterday with the election results of, I don't know that guy's name, but the guy that came in first in the way, I don't even understand how the election thing works here, but I know he didn't win. He's just like teed up to. In any case, the answer is for a long time, whether people thought the government was good or not, thought they were efficient or not, there was a general view that the things that were said were reliable. And there's less of that now. Because it's, by the way, and I don't know if it's healthy or unhealthy, so I'm not being political, I'm just answering it from an investment question. I'll give you a good example. We do a lot of investing in the area of defense. Early stage stuff, not a lot of late stage. And early stage defense has to make an assumption that they're going to have customers, and obviously if it's defense, customers is the government. And the ability to underwrite that today is a lot harder than it used to be. And so wherever we're looking at investment opportunities that rely on the government for the opportunity to prove to be successful, we are much slower to move because we don't think we can handicap that sort of outcome. Maybe it's doable. We don't think we have that edge. And so it's harder to play in that field. That's separate from what do you think of the things that get said? And I don't want to have a political thing. I'm trying to answer it from an investment perspective.
If a client came to you tomorrow in a client meeting and said, what 2 or 3 areas of investing are you most excited about in the next 12 to 24 months? What would they be?
12 to 24?
Well, I know that's a short time horizon, but I mean, what areas are
Healthcare.
exciting?
Healthcare. Most aspects of it, but more so on the early stage because of what I already said. From an asset, like from a bucket perspective, for the last, you guys have to know this, I'm assuming most of the people in this room are investors. The last decade, the place, hindsight's great, and with hindsight, the last decade, the place to be was just passively invested in the S&P 500 or the Russell 1000 growth, and you made a ton of money. We believe very strongly that song has been sung and that play is over, and that forward-looking, which is really how you have to invest, stock pickers and people that have the ability to pull away from an index are the people that are going to do best. So I think you're going to see more activity in the hedge fund world where there's been a lot of compression in terms of competition, in terms of dollars, in terms of fees that are charged. I expect
Need for liquidity.
Yeah, and need for liquidity or a desire for liquidity. Lots of people don't need liquidity as much as they think they do, but for the desire for liquidity.
Well, I'm just talking about the frustration of private equity hasn't returned as quickly as it has in the past.
Yeah, and it probably won't for a little while longer. So if you have a lot of private equity, I hope it's good.
I wanted to touch on private credit for a second because it's the buzzword, and you guys know a lot about the credit space. You raised a closed-end credit vehicle you have that's open to people that are, or was open to people that are outside of your core client base. But I went to a different conference earlier this year, and at one of the tables that one of the vendors or managers had, there were boxes of mints with private credit on the top. And I thought, oh, here we go. Okay. Thoughts on that?
There's a lot to do.
When I talk about private credit, I'm talking about direct lending, really, right?
We don't do much in the direct lending world. It's probably the most crowded part of the umbrella that's private credit is the direct lending world. But there's a lot of opportunity to make money. If you think about this, when you invest in private credit, you're generally investing in some form of higher yielding something. You're taking credit risk and you're taking less interest rate risk and more credit risk. So now the question becomes, do I want that credit exposure where I can get out of it, like a high yield public securities manager, or do I not need the liquidity and can I get a liquidity premium by locking it up into some sort of illiquid vehicle? I don't know why this continues to persist, but the spread that we are earning in the private credit bucket relative to the public credit bucket for comparable credit risk is too high. It shouldn't be that high. It's partly probably because of what you just alluded to when you made your comment about liquidity. Because lots of investors put a lot of money into private credit, private equity, and a lot of money into venture capital, and it's not coming back as fast as they wanted. So they have this imbalance. There's maybe more desire for liquidity, and because of that, the premium on illiquidity is greater than it should be, but you shouldn't be able to earn 500 basis points more just because you've tied up your capital for a 5-year period. I don't believe you should. I don't think that makes any sense, because the bottom line is the credit risk is the credit risk. And if you can underwrite that, which you can do public or private, that's why we're doing it. And as long as it stays that rich, we'll keep doing it. When it goes away, we'll stop. Did I answer you?
Yeah,
Okay.
I think so. Did
Okay.
he answer me?
They're not going to say no.
You mentioned VC, which we haven't touched on. There is this mantra, VC is.
Suzanne, can I just jump in for 1 second?
Sure.
Because we're talking about private credit. Can you talk about duration in private credit? Because we have every type of manager that comes to us. So a lot of it's, you've got gap financing and real estate. Anything that are your favorites? I know it's a crowded space, but the longer duration stuff seems to have turned off a lot of family offices. They're liking a lot of shorter duration gap financing. Thoughts?
Most of the longer duration stuff that we see is on the long duration side of real estate backed securities. Generally speaking, corporate lending is not going to be long duration because underwriters just won't do that. So when you look at private credit investing, just generally, if any of you invest in private credit, most of your time is spent analyzing the credit worthiness of the borrower, not the interest rate risk of how long the money is going to be out. Because most of the reason you're going to either get rewarded or get hammered is going to be because the credit improves because you were right about the business, or the credit deteriorates and they default. It's not going to be because of the term of the loan, because it's not like buying a 30-year bond. That doesn't exist in the private credit world in any sort of real way. So it's not really an interest rate game. But the truth is really this. Think about this and it'll make sense to you. If you're a lender and you find a borrower who you think is good, and they're going to pay you 15% to borrow money, their incentive is to pay you back as fast as possible. And if you're the lender, you want them to keep the loan outstanding as long as possible. Because if they pay you back in 2 years, you just have to go do the whole thing over again. So there's a perverse relationship in the private credit world that the reality of it is, if you're good at selecting your credits, lenders want the duration to extend as long as it can, and the borrowers want it to end as soon as it can. So that tugs away from interest rate risk.
I just have one more question, Suzanne. I'm sorry. CLOs and there's something that's like snuck into ventures. I think it's called like pref equity or something like that. That seems to have it's a version of debt that is senior or something. Maybe you can just, where are you on CLOs?
We don't do a lot in the CLO world. We actually only have an investment in one today, and we've had that since, gosh, I don't know, for like 18 years now.
Wow.
Yeah, for 18 years we've had the same CLO, and it's thrown off I don't know, call it a 12% annualized return for all that time. And it's like the gift that keeps on giving. So we don't do a lot there. There was a second half to your question.
Prep equity,
Oh.
there's something that's out there that, and it's snuck into like every venture capital deal.
Yeah, well, what do you want to know about it?
Why is everybody throwing it into the deals now? It wasn't there
Because
before.
because they can.
Is that what it is? Yeah.
Yes, that's
what I
why.
thought, yeah.
The market tells you what you can do and people do it. It gets a little tricky and it requires more underwriting understanding. My very first job right out of business school was here in New York City. Again, this is like the Art Laffer relationship. The people who know who Art Laffer is know what Manufacturers Hanover Bank is. And the people who don't know who Art Laffer is have never heard of Manny Hanny. So for you Art Laffer people, I used to work at Manny Hanny and I got credit training there. And we use it, right? It's valuable. And they do it because they can. We don't tend to invest in much of it, but once in a while.
Sorry, Suzanne, you got about 15 more minutes, but keep on going.
Okay. So where I was going is there's sort of a mantra in the marketplace that VC is over, VC is less attractive. There's not going to be the same kind of returns in VC. The exits are much harder. How are you looking at investing in venture today?
Well, first of all, most of what you just said, that is what's being said, and we think it's mostly not true.
Okay.
Okay? We actually think.
I didn't say I thought it was true
I know,
either.
I know.
I'm just saying it's out there.
Yeah. So we actually think that investing in the venture space, because of AI, is going to become less risky and become decided, whether it's win or lose is the decision, but decided faster. The time horizons, like what these guys do, the time horizon for them to make what they're doing work or not is going to happen in a faster pace, which means that the investors are going to turn their money at a faster rate than perhaps they did before. You're talking about a macro of the market, right? There's all this stuff that's clogged. People don't know what they want to do. The M&A market is struggling because of government policy and whatever. So all those things pass. There is plenty to do in the venture space. There's lots going on in healthcare. There's lots going on in defense. I mean, like you guys have heard of companies like Palantir. Palantir is a venture-backed business that hasn't been around for that long. And there'll be more of those. So don't shy away from it. You just have to. The problem with venture and all of this stuff is that people stuffed themselves. They consumed too much because they believed that it was like easy money or whatever. I don't know what they believed, but they over allocated, and now there's congestion, and that has to work its way through the system. That doesn't mean that the system's not going to work. It just means that some people won't participate because they either can't or whatever.
So that leads into a good point. ICG, as a rule, never say never, doesn't really invest in direct deals. You invest in managers.
Yeah, generally,
And-
right. And we do co-invest that come from those managers
Co-invest,
for
but
some of our clients.
they're coming from managers you trust. So
Yeah.
when you figured out you like the space, maybe you like the returns, how do you know with a man? I mean, a guy I used to work for used to say the hardest part about investing is figuring out whether a manager is lucky or truly skilled, right? Because statistics tell you that Wall Street Journal darts on the board can work. How do you determine if a manager has been, because what they make you say on the front of a prospectus in our business is
Yeah.
past performance is not necessarily a guarantee of future results. It's almost, we're the only business where that's kind of true. Like if you make good widgets yesterday, you make good widgets
Well,
tomorrow.
part of the answer to your question is depends on the asset class. You're trying to determine if there's luck or skill. So look, that's what our business is, right? Our business is trying to evaluate that some manager that does something has some sort of identifiable, repeatable process that is going to generate some sort of differentiated return stream that you can't just get less expensively with more liquidity, with more tax efficiency. And if you can't find that, then you should get it less expensively with more liquidity, right? You should. But finding that, I think, is the art of what firms like ours do. And I don't think in a thing, I don't know how to explain it, other than to say we do it and we know how to do it, and we're right way more than we're wrong. So, it pays off.
So let's say you do the work on a manager, you like the strategy, you like the return stream, but you ultimately decide the guy's a jerk. What do you do?
Well, when you say the guy's a jerk, I don't know what you mean by that. You mean he's just,
You don't like him.
generally, we don't figure out we don't like them after all this work's been done. We figure out that we're just not going to get along. We like to be partners with the managers we invest with. We view it as a partnership, and it's a three-way
That's why
partnership.
they call you limited partners.
Yeah. And we view it as a three-way partnership. It's our client's capital, it's us in the middle, and it's the manager doing whatever they do. If we don't feel like there's going to be a good flow of information and a aspect of respect between the firms, we just move on. There's lots of managers. There's so many money managers out there. It's insane, right? There's way more money managers than there are stocks. There's plenty to choose from. So I can't think of a time where we've done all this work and we like everything. We say, well, the guy's a jerk, so forget it. Like why'd you waste all that time?
Well, guys can be nice until you figure out they're not.
Okay, well, I think generally speaking, the answer to your question is we would probably not invest with a manager who we thought was, using your words, a jerk.
Okay. I'm going to ask a last question. I'm going to open it up to the audience for a minute before we go to the lightning round.
Okay.
So what do
By the
you,
way, I'm going to make a comment about the jerk thing.
okay,
Sometimes when a manager's a jerk, they're not necessarily a jerk, they're hiding something. And the most illustrative case of that I can think of in all the years I've done this work is Bernie Madoff, who we never invested with and had never even heard of until a friend of a client asked us about him. And so a friend of a client asked us about this guy, and I said, well, I've heard of him before, but I don't really know who he is. And the bottom line is, asked us if we would do a meeting. So we did. It was less than a half-hour meeting, and it was over. And it was because it wasn't they were a jerk, they wouldn't answer our questions. Any penetrating question that actually mattered, they wouldn't answer. And it was confidential, it was proprietary, blah, 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 whatever. Today, they get around it with the NDA thing, but everybody will just sign them. But back then, that's not how it was. It turns out he was a jerk, but what it really turned out is he was hiding something, and what he was hiding was a scam. So the jerkness aspect of it is really the flow of information. We don't invest with managers where we can't sit down and tell our clients we understand what they do and how they do it. Period. Doesn't mean we're right about whether they're good at it, but we understand it. And if we can't understand it, we don't tell clients to do it. So I told that guy, by the way, I wouldn't invest with him. Turns out he did. Turns out he later sold his business. Turns out when he sold his business, he gave most of the proceeds to Bernie Madoff. And I only found out about it a couple years later when I called him and said, is Bernie Madoff the guy that we did that work for you, blah, 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 I told you about? Yeah. He hadn't heard the news. He had not been, anyhow. So there's your jerk story.
I have a quick question. I think we have a couple other questions, but
Okay.
but so Jeff, something that came up yesterday with Kevin Ryan was, a lot of people believe in what they call like wave investing. There's like a wave of technology. There's a wave of new financial products, et cetera. And it's always better to get in early before later. I think that's pretty high demanding on what you guys do from a research point of view, because as you pointed out earlier, you kind of have to predict the future. Can you talk about like interesting waves that happening that
When you
kind
say
of
wave, do you mean?
new trends, right? I mean, if you were in venture capital in 2005, it was nanotechnology, right? Today it's AI, right? But at the same time, I mean, financial products you see, right? Peer-to-peer lending.
I'm the wrong guy to ask about waves.
Okay.
I can't surf. Like, I don't know.
Yeah, you're in but you are in the
So,
you're in a hotbed of innovation in LA, right?
Yeah.
So
But-
I think Pete Thurlow has a question. Pete Thurlow?
uh,
Pete?
Jeff,
Pete?
then Steve. Steve, I'll give you the microphone next.
Pete, yeah.
Hi, Jeff. So
Hi.
I'm on the next panel, Venture Capital. I'm actually an IP attorney, been friends with Marty for years. I was in the military, so I work with DARPA, so I'm very familiar with what you're talking about on the
Yeah.
defense side. And you mentioned Palantir. Other companies that, can you name some other companies you're interested in? Obviously, I'm very excited about Perplexity on the AI side, very excited about what Anduril's doing there recently, just on 60 Minutes. Curious to get your thoughts.
We're invested in all those, but all of them came through venture funds that, like, I didn't figure out what Anduril was and tell our clients, you should go put money into Anduril. Our venture managers did, and they worked great. Like, you've heard of all these guys. If you're in the venture world, you know these guys. Like, you may not know. Do you know who Red Cell is? Okay, so Red Cell would be a less known venture name. They invest in healthcare. You guys should know them. And defense, and that's it. All early stage. I think they're interesting, but they were probably not that well known. Whereas someone like Lux Ventures, probably everyone has heard of Lux Ventures. They're also coincidentally headquartered right here in New York City. So it kind of like covers the gamut of what we'll look at from a venture perspective. But what's your question about that?
Other companies that you've seen maybe through the managers you're invested in that you find interesting?
No. I mean, not that I pay attention to. Sorry.
So let me get back to
There
this.
probably are, and I'm not remembering them.
Uh,
Yes, sir.
Do you invest in the company itself or the companies investing in companies? Because we're a hybrid. So it may or may not fit your criteria. And
Managers only.
Is that what you're asking? What are you asking me?
what I'm saying
That-
is do you invest in the transaction or the companies that invest in the transactions? So in essence, if I'm a VC, you'll invest in me. If I'm a hybrid of a VC and or private equity, would you take a look at that? Because you're investing in a portfolio.
What we do is we invest in a venture capital fund. Like, name the fund? One of the ones that Fred started.
Lux, Red Cell.
And they invest in companies. Sometimes those managers will say, hey, we have a company, Anduril, use that. And they're doing around, and our fund has pro rata rights, and we can take a certain amount of it, but there's more left over, and they offer the direct investment into that company to their LPs. We will sometimes make that investment. Is
But
that
that's usually through a special purpose.
Fantastic,
vehicle.
great. So,
What we have is a hybrid.
Can we talk a
hybrid
little bit?
situation?
Steve,
Might
let's-
fit or might
No,
not.
I
We
can
gotta
talk
move
to you
on.
afterwards.
can we talk a little about secondaries and continuation funds?
Sure.
It's a big topic for our group.
Yes. Okay.
Sure.
What do you want to talk about?
Yay, nay,
Yeah, absolutely.
go long.
Yeah. We've been investing in secondary funds for a very long time. What's forming now are secondary funds that are going into secondaries of private credit, which is because there's enough private credit that's actually in the system now, and there's enough people that have congestion from their overly committed private equity and venture capital books that they need to find liquidity. And so they're trying to sell things. And there's private credit secondary. I think secondary investing is great, right? I do, because you get to see what you're buying because it's already there. You get to value it, and you get to put your money to work all at once, as opposed to a normal private credit fund where you commit $10 million and it takes them 3 or 4 years to put that money to work. And so you really don't have, all those dollars aren't working. In the secondary world, they work right away. So I'm certainly a fan of it. Sure. Is that the question? Do we like it? Is that what you?
just where it is now, because, you know, in 2009, when the market crashed, it was pretty spectacular, right?
Yeah, it's not that juicy
It's
now.
not that anymore,
no,
right?
no, no.
And there's so much money in it also.
Yeah, but
And-
there's still opportunity, I think.
And people have different perspectives towards LP secondaries versus
Right.
GP secondaries, you know, et cetera. So I don't know if you differentiate between any of them.
We do, but generally but our firm likes looking there, and I don't know why anybody wouldn't look.
So let me get back to my last question before we go to the lightning round. What is
I
keeping
thought
you?
that was the lightning round. Okay, go ahead.
What is keeping you up at night? What do you think the biggest risk or risks ahead are?
I think the biggest risk, the reason it's so easy to not get too worked up about this is because it's not going to happen quickly. But I really do worry about the way our nation spends money and the way we borrow it and the way we keep piling on more and more debt that we're passing on to future generations. There will come a point. This is the part that people can't get their heads around. You know what the problem is? 36, whatever the number is these days, $36 trillion. Numbers get to a point where they're so big that they kind of lose meaning and you don't really process what that actually means. But there's going to come a point where people are in a real way, not in a political way, in a real way are going to say, I'm not lending you money anymore. Or you're going to have to pay so much interest to get a loan from me, meaning the world. And that is going to, and this is the world's reserve currency. The United States dollar is the world's reserve currency. And for now, it's really the only currency that can serve that function. I mean, people talk about China, and I do not believe that is possible. So we have this advantage, but I think we are irresponsibly taking advantage of the advantage. And what worries me is when that music stops, anything we've seen in our lifetimes will be nothing compared to what you'll see if and when that system breaks down. But it's not going to happen in the next 5 years. So,
So
just keep spending your money and don't worry about it.
So this was a lightning round question, but I'll ask it now on the back of that. Somebody yesterday said, you know, they didn't really believe in crypto, but it could be useful as a reserve currency. My question to you is going to be, you know, crypto, is it hype or is it here to stay? But
Oh, it's definitely, well, it's both. It's here to stay, but crypto is not going to be a reserve currency. The whole point of crypto is decentralized finance. That's the whole point of it, right? You guys know, I'm assuming most people know that part of it. That's why it has an attraction. By definition, a reserve currency is controlled. It's the opposite of decentralized. It is centralized control. You're not going to, I don't see that in our lifetimes where crypto becomes the reserve. That doesn't even make, that's nonsensical that it's a reserve currency, but I think it's hype, but I also think it's here to stay. Some variation of it. You know, I kind of liken things like if you think about the internet and you think about blockchain, I think of those as similar. And what rides on the rails of the internet are browsers and what you see, like Google, and remember Netscape? You guys remember Netscape? The young people probably don't, but everybody else does. Netscape at one point in time was it. It's gone. So you look at cryptocurrencies, some of them are going to be around and they're going to last, and they ride on the rails of blockchain technology, and others will be Netscape. And I don't know which is going to be which. It kind of seems like Bitcoin probably has got enough critical mass at this point where it doesn't just go away, but I wouldn't walk away from this conference relying on that last statement as the best thing you learned from this half hour, if it were me.
If you had a mentee that came to you, like somebody that went to your school, you know, that said, I want to go into the investment business,
Uh-huh.
what advice would you give that person?
to do it. I mean, like, what do you mean?
But like, what's your path?
I
Like,
think it's great.
where do you start? Where do you?
Oh, I
eh,
would tell them there's no free lunch. Don't get caught up in hype. It's hard to get people to figure out what they want to do when they're young. I mean, I only got into this business because I didn't know what I wanted to do. So, but if somebody said they wanted to get into the investment business, I would tell them, I don't know that there's the right path, right? Like banks, or maybe they used to, I don't know if they still do, but they used to have training programs. And there's value to those. I remember there was a kid who worked for us as a summer intern. We have an intern program at our firm, and he worked for us years ago. He was a Tufts University student, worked for us as an intern, loved the business, so he said. And he was graduating, and he said, I want to get a job with you guys. Can I come work for you? And I said to him, you know what? You go to Tufts, which is in Boston, and Cambridge Associates is right there. And they've got a really robust training program in this world of advisory, research, consulting, whatever you want to call it. I'll call people there and get you an interview. You should go work there for a couple of years and just get some experience instead of coming to a firm like ours, because you're not, and I gave him that advice. Now, I don't know that I'd give it to him today, but it's like there are no shortcuts. There just aren't. It's hard work. It's tenacity. It's get in early. It's leave late, and go to the office. Depends on what you do, right? There are businesses where you don't need to be in an office, but the investment business is a people business, and it's a looking each other in the eye and having spontaneous conversations that you wouldn't be having on Zooms, because you can't spontaneously Zoom, and all of that feeds
And it's interacting with the senior people.
Yes. So there, go to the office.
Okay.
Okay.
How much time do we have, Marty?
I'll give you another 5 minutes.
Okay. So let's do 1 or 2 questions from the audience if there are some. And then I've got a couple quick more.
Okay.
Do you want me to ask a question or not?
Go ahead.
No, I don't have to. I could-
Well, I wanted to give others a chance because you would already, is there anybody else that?
I think I have a couple of questions here.
Okay.
So we had talked earlier, about the credit markets, and we talked about the secondaries. Can you talk? So we recently had something that happened with a manager who became too large with one customer. Do you look at the balances, and then the customer had to withdraw all their money, and it caused the whole portfolio to go into a fast decline? Do you ever look at that kind of stuff in terms of like, are they too dependent on one investor, or,
I don't know if you're trying to like tee up like a softball question or if you're serious, but
it's a softball question, and I'm hoping that you knock it out
Okay.
of the park.
Well, anyone who does what we do, who doesn't do that, if you find out that they don't do that, you should just be polite and leave. Of course we do.
Yeah,
Yes.
manager
Yeah.
scope creep. I mean, this kind of stuff,
Yes.
it happens
That's all
especially with
part
the
of-
merging one.
Yeah, you guys, that's all part of operational due diligence and understanding the revenue streams that, when we invest with the money manager, when we get to the ODD part, we want to understand the revenues that that firm earns and the expenses that firm has, and we want to know that they can stay in business. And one way they could go out of business is if they've got too much of their revenue coming from one client, and that one client is not some sort of like contractual client who like was an early seed investor in the fund and is locked up for the next 5 years. That's a very big red flag thing that we pay attention to. That doesn't necessarily mean we won't invest, but the notion of not knowing that and making sure we've cleared that check and we understand it is very elementary.
Again, I think a super experienced manager who you thought, wow, this guy's an old hand, he's going to know how to do it. But COVID happened.
Yeah.
The client said, I need my money now. They
Yes.
withdrew 50 million and, right? So,
Yeah.
No, I would just gonna say, I would add to that too. Not only is it customer concentration, it's the kind of customers.
Right.
You want to see pension funds, endowments, foundations, high net worth. If you have back in the day, fund of funds aren't really the same business that they were years ago. But if you had a huge concentration in fund of funds clients, going into the financial crisis, you were toast.
You fired a bunch of fund to funds at the one firm we invested with you,
In
at Claren Road, when you got there.
Well, I didn't fire, no. What happened at Claren Road was their assets got cut in half because the fund of funds redeemed. The good news was when I got there, the ones that were left were sort of the good players. What I did in order to diversify the client base going forward was limit how much money they could
Okay,
put in
right.
going forward or change their
So the other
terms.
firms would invest and not be afraid of that.
Correct.
and
So-
just
so-
one last other question. 7 years ago, we were in LA, over at, I forget the name of the company. Jim Scheinberg was there. You might know him. He's a good guy. And we had Pantera was presenting about Bitcoin, and it just hit 30,000. And Jim said, if Bitcoin goes up another 10x, it's going to seriously disturb the world currency markets. And I know you talked about a little bit, that's not a reserve currency, but at the same time, I mean, we're at
Okay.
100.
So Bitcoin's 100,000 now?
Yes.
Do anybody think that the world's currency markets have been seriously disturbed? There's not a chance that one hand's going to go up. That's
Perfect. Great.
That's
Okay.
not
So-
true.
Short
It could
question,
go up
short answer.
tenfold more. It won't disturb world. That's not
Interesting.
real.
Suzanne, just a quick question, then Chip has a question.
Okay.
So Jeff, you mentioned, I'm over here.
Yeah.
You mentioned briefly China. As I work with state and the federal government and many family offices, my question to you is, what's your views on China? Are you doing any investments directly in China with the 8 billion?
No.
Or, okay,
No, the only China exposure we have will come through some global managers that may have some exposure, but we don't proactively say we have to have money in China. We're not big enough to do that.
And you also don't tend to invest in country-specific
Yeah,
funds. Yeah.
we're not big enough to start
It's not
deciding
just
we could be
China.
in India or China or name your country. So no.
I will tell you all that I've been showing Jeff funds for
Long time.
25, 28 years. And I think he's invested in 3, so he's very picky, and I'm very good at picking funds, so.
You are.
If you do say so yourself.
But a pleasure to work with, and your team is amazing.
Thank
I
you.
just wanted to let you know.
I agree with that statement. My team is amazing.
As you should.
Is that a
They're
paid
great.
announcement?
I think I said it at the beginning. So my last question, and your wife and daughter and son-in-law are in the room, so
Uh-huh, they are.
I don't know if they're gonna like your answer or not like your answer, but if you weren't doing what you were doing, and
Uh-huh.
you have to keep in mind, Jeff really works 24/7. He's on his phone even when you're at dinner with him. He's talking to managers. I've got to do this. I've got to do that. Like he's got his finger on the pulse at all moments. But if you weren't doing this, what would you do?
Do you mean if I hadn't done this, what would I have
No,
done
If
today?
you, yeah, today, if you,
I
if-
don't know. I'm not qualified to do anything else at this point. But when I was younger, before my wife and I got married, I thought I was going to go into politics. That's what I wanted to do.
it's very funny. Kevin Ryan yesterday, when I said, if you weren't doing this, what would you do?
the
He
same
said,
thing?
he didn't say when he was young. He said, 7 years ago, I thought about running for mayor, but it's off the
Yeah,
table. I'm not
yeah.
doing it.
In any case, I was going to go
Colin
into
Collins said
politics.
he'd go to the beach. Everybody has different answers.
No, I wouldn't go to the beach. I would probably go to the golf course, but that's not really an answer.
Well, it has been a pleasure having you and, fun to interview someone who I know so well.
Thank you very much for having me, everyone.
Great job. Thanks so much.